Welcome to this earnings explainer. Look, if you're tracking Malaysian manufacturing and export equities right now, you already know things are getting, well, a bit wild out there. Today, we're putting on our equity research hats to unpack a major development with Lihen Industries Berhad, or LHIB. We're looking at a severe earnings reversal in their latest quarterly report. Over the next few minutes, we're going to objectively dissect exactly why this happened, figure out if this structural shift is actually sustainable, and highlight the future catalysts you absolutely need to keep on your radar.
Okay, let's dive into this bottom line right up front. For the first quarter of 2026, LHIB's pre-tax profit didn't just dip, it literally plummeted. We're talking a massive 178% drop compared to the same quarter last year. To put some real numbers to that, the group swung from a pretty healthy RM6.22 million profit straight into a severe RM4.86 million loss. For an established manufacturer like LHIB, a reversal of this magnitude in a single year-over-year period, that signals some massive fundamental shifts in their operating environment.
And this brilliantly illustrates the root of that bottom-line pain, a severe top-line contraction. Back in Q1 2025, LHIB was generating about RM 164.59 million in revenue. Fast forward just 1 year to Q1 2026, and that figure has collapsed to RM 99.46 million. That is a brutal drop of nearly 40%. This kind of revenue wipeout across their key product categories, things like bedroom sets and office panels, meant that lower production volumes were suddenly slamming into relatively fixed labor and overhead costs. Ultimately, that dynamic just completely destroyed their profit margins.
Section 1. The Perfect Storm. Unpacking the Headwinds.
So we can essentially categorize this new operating environment as a perfect storm. It's really driven by three massive external headwinds hitting all at once. First, you've got severe disruptions from shifting U.S. trade policies. Second, a highly unfavorable foreign exchange environment. And third, a simultaneous spike in both domestic compliance and international logistics costs. Let's actually unpack these one by one to see how they squeezed LHIB from literally every angle.
The first major blow came directly from trade policy. Prior to April 2025, LHIB was operating under comparatively favorable market conditions. But then, the U.S. implemented a series of heavy tariffs on furniture imports. It started with a 10% baseline in April 2025, and then escalated all the way to 19% by August. Because the U.S. is such a core market for LHIB, these sudden tariffs forced the company to just absorb the burden through price pressures and margin erosion. It heavily suppressed U.S. consumer demand, which meant LHIB had to offer even more trade discounts just to move their inventory.
Now, what's really interesting about this metric is how currency dynamics further amplified the pain. As an exporter, LHIB's revenue is heavily tied to the U.S. dollar. In Q1 2026, the U.S. dollar depreciated against the Malaysian ringgit by approximately 10.8% compared to the previous year. It dropped from roughly 4.44 down to 3.96. So think about that. Not only were they selling less furniture because of the tariffs, but the dollars they were actually earning translated into significantly fewer ringgit. This single factor severely crippled the overall value of their export revenue. And while that top-line revenue was shrinking, the cost to actually operate was inflating. Domestically, LHIB was hit with a minimum wage hike in February 2025. Then, that was followed by a new mandatory 2% EPF contribution for foreign workers in October. Adding to this domestic pressure were geopolitical crises. The escalating conflicts in the Middle East severely disrupted key shipping routes, like the Red Sea and the Strait of Hormuz, which just drove up global logistics and raw material expenses. So you have less revenue coming in and vastly more money going out.
Section 2. Management Strategic Response. Let's move on and see how this builds the case for long-term survival, because management definitely isn't just sitting still here. Step 1 is aggressive internal cost rationalization. They're optimizing their workforce, they're tightening operational cost controls, and they're really accelerating the adoption of automation technologies to try and offset those rising domestic labor costs. Step 2 is a crucial strategic pivot, market diversification. Recognizing the massive danger of relying too heavily on U.S. buyers amid all this tariff volatility, LHIB is now actively expanding its customer base into the ASEAN and Middle East markets to spread out their geographic risk.
Section 3. Future Catalysts and Key Risks.
Trade policy absolutely remains the biggest wildcard here. In February 2026, the U.S. Supreme Court actually struck down a large chunk of those Trump-era tariffs that had been hurting exporters so badly. But in response, the U.S. immediately introduced a new, temporary global tariff of 10%.
Now, while this does create a slightly lower tariff window for LHIB right now compared to that previous 19%, the overall policy environment is still highly, highly unpredictable. Global trade disruptions stemming from all this legislative back and forth are likely to persist, meaning LHIB's pricing power is going to remain pretty constrained for the time being.
So the crucial point is that LHIB's return to profitability hinges heavily on macro stabilization. Look, management has the internal cost structures in place, but can they truly outmaneuver a global trade environment that seemingly rewrites the rules every few months? That is the ultimate question dictating their future. You've got shifting trade policies, currency fluctuations, and ongoing freight impacts all in the mix, and that is exactly what investors should monitor over the next 2 to 3 quarters.